Good afternoon, everyone, and welcome to our presentation on the Consolidated Appropriations Act and how it affects 2020 and 2021 tax filing issues. My name is Ed Decker, and I'm one of the presenters. We also have Brad Shimko and Serena Yang. These are the areas of the act that we're going to be covering. We're going to be talking about how it affects the individual tax filing issues, then business, and then we're going to talk specifically about the employee retention credit. For CPE, we will be issuing or polling questions will be coming up throughout the presentation, and you will need to answer those questions and then to get your CPE credit. And then there'll be a survey at the end for you to link to and fill it out. Any questions that you have, because of the amount of information that we have to present, we're probably not going to have time for a Q&A session, so please email any questions you have and we will answer them accordingly. The handouts are available as PDF downloads, and we're also recording the webinar in case you want to follow on or listen to it later.
Hello, everyone. My name is Serena Yang. I am a senior tax staff in our Columbus office. If you attended our tax annual update last month, our presenters from the tax department covered a variety of topics regarding the COVID-19 related legislation that has been passed so far. And let's move on to next slide. Like Ed mentioned at the beginning, on December 27th, the President signed the Consolidated Appropriations Act 2021. This bill is the fourth major relief legislation enacted in response to the pandemic and serves as a vehicle both to provide additional COVID-19 relief and to fund government operations through the fiscal year. The CAA contains the COVID-related Tax Relief Act of 2020 and the Taxpayer Certainty and Disaster Tax Relief Act of 2020. Today, I would like to go over some key provisions in the most recent COVID relief legislation that may directly affect individual taxpayers, and later my colleagues Brad and Ed will help you understand the bill from the other aspects. And next slide. I wanted to first start with the recovery rebate, also known as the Economic Impact Payment, EIP, or stimulus checks. To recap on what we have already covered coming out of the Cares Act enacted earlier in 2020, we know eligible individuals received an economic impact payment that is equal to the sum of $1,200 per taxpayer plus $500 per qualifying child. The Consolidated Appropriations Act provides a second round of the economic impact payment in the amount of $600 per taxpayer plus $600 per qualifying child. This second round payment is also subject to the same phase-out rule as the first round stimulus checks, starting at $75,000 adjusted gross income for singles or $150,000 for a joint return. The payment will be reduced by 5% of the amount by which your AGI exceeds the applicable threshold above. And here is a quick example to show you how the calculation works. Assume a single taxpayer reported $80,000 AGI on 2019 return. Based on this phase-out rule, this person will get a reduced second round EIP of $350. And next slide. The CAA also made the following amendments to the Cares Act Eip. First, the $150,000 limit on adjusted gross income before the credit amount starts to decrease, which under the Cares Act applied to joint returns, now also applies to surviving spouses. And we know that in order to be eligible for an EIP, taxpayers must have Social Security numbers. The requirement to provide the IRS with a taxpayer's identification number is now made identical to the same requirement under the new rebate provided by the CAA. And next slide. So far we know there are 3 possible channels through one can receive an EIP. The payment can be automatically issued to eligible individuals based on information provided on 18 or 19 tax returns. For non-filers who are eligible, they could have provided information through the non-filer portal on IRS website. But to the best of my knowledge, this tool was actually closed as of November 21st last year, and it will not be available for the second round economic impact payment. The last channel for anyone else who are eligible but did not receive an EIP, either the first or the second round payment, taxpayers will be able to claim it when they file their 2020 taxes. So let's move on to next slide. Here is a screenshot of Form 1040, page 2. I've highlighted the spot where one can claim the recovery rebate credit on the tax form if applicable. As you can see, it is showing on line 30. It is worth mentioning that taxpayers who receive an advance payment that exceeds the amount of their eligible credit will not have to repay any money back to the government. If the amount of the credit determined on the taxpayer's 2020 return exceeds the amount of the advance payment, or to put it more simply, they didn't get all the money they were supposed to, taxpayers will receive the difference as a refundable tax credit on 2020 tax returns. And next slide. Previously, we have covered that the CARES Act made 3 major changes on individual charitable giving. The CARES Act provided that for 2020, individuals who normally do not itemize deduction may take up to a $300 above the line deduction for cash contributions made to qualified charitable organizations. A 20% penalty applies to tax underpayments attributable to any overstated cash contribution by non-itemizers. And for 2020, the limit on cash charitable contributions by an individual was increased to 100% of the individual's adjusted gross income. So the CAA 2020 extended the above deduction rule, allowing individuals an above the line deduction for up to $300 for cash contributions per taxpayer, meaning joint filers in 2021 can claim up to $600. And to avoid any abuse, taxpayers who overstated their cash contributions when claiming this deduction are now subject to a 50% penalty. The 100% AGI limitation on cash charitable contributions is now extended through 2021. And next slide. Now let's move on to education updates. Under the pre-law, there were 3 existing education-related tax breaks available to taxpayers. One can choose to claim an up to $4,000 deduction on qualified tuitions and fees. You also have options to pick either a lifetime learning credit or American Opportunity Tax Credit, AOTC, which used to bear 2 different income phase-out limitations. The CAA first removed the tuition and fees deduction after 2020, and in exchange for eliminating this temporary deduction, the CAA increases the income limits of the lifetime learning credit to now match AOTC. Note that AOTC, American Opportunity Tax Credit, the phase-out limit remains the same. This change would help clean up a lot of confusions when it comes to decide which tax credit best fits your situation and provides you with the optimal benefits. And next slide. The Act also provides that eligible educators, that is kindergarten through grade 12 teachers, instructors, etc., can claim the existing $250 above the line educator expense deduction for personal protective equipment, PPE, disinfectant, and other supplies that used for the prevention of the spread of COVID-19 that were bought after March 12, 2020. In addition, educational assistance provided under an employer's Qualified Education Assistance Program up to an annual maximum of $5,250 is excluded from the employee's taxable income. Earlier, the CARES Act amended the Internal Revenue Code to allow student loan repayments to be treated as non-taxable employer-provided educational assistance, and this CARES Act relief was originally set to expire on December 31st, 2020. The CAA now extended the relief previously afforded under the CARES Act to employer loan assistance provided through December 31st, 2025. And to all our guest audiences, if you're curious if any of these changes apply to you or your family members, our tax team would be happy to have a conversation with you later. And next slide. I wanted to quickly cover a few more extenders made by the CAA that may directly impact individuals. And I apologize in advance for some of the Internal Revenue Code language here. For tax year beginning 1/1/2021, taxpayers can claim an itemized deduction for any unreimbursed medical expenses that exceeds 7.5% of your adjusted gross income. This threshold was originally scheduled to go back to 10% for 2021, which would make it more difficult for taxpayers to qualify for medical deductions. The CAA now permanently set the threshold at 7.5. Under the pre-law, mortgage insurance premiums paid or occurred before 1/1/2021 by a taxpayer in connection with acquisition indebtedness with respect to a qualified residence were treated as deductible qualified residence interest. This treatment is now being extended through 2021 for amounts paid or incurred after December 31st, 2020. Again, under the pre-law, discharge of indebtedness income from qualified principal residence debt that is up to a $2 million limit or a $1 million for merit filing separately was excluded gross income. The CAA extended this exclusion to discharges of indebtedness through 2025. The CAA also reduces the above maximum acquisition indebtedness limit down from $2 million to $750,000 for taxpayers other than merit filing separately. And lastly, I wanted to briefly mention two energy-related extenders. So the non-business energy property tax credit equals to 10% of cost up to a lifetime cap of $500 have been retroactively extended from December 31st, 2017 through end of 2021. Individual taxpayers were also allowed a personal tax credit known as residential energy efficient property credit equal to the applicable percentages of qualified expenditures. This includes solar energy systems, water heating systems, fuel cells, and small wind energy property, etc. This credit features a phase-down applicable percentage depending on the property placed in service year, and it is now being extended under the CAA for property placed in service before 1/1/2024. Along with what I have covered so far, there are numerous tax extenders being included in the most recent tax bill. And it's just a reminder to all our HW folks, Checkpoint is a great source if you wish to read more in detail. Next slide. So the CAA now allows taxpayers to use 2019 tax information for the purposes of claiming Earned Income Tax Credit, EITC, and Child Tax Credit, CTC, for tax year 2020 if it will be more beneficial to taxpayers. A little bit background here. The Earned Income Tax Credit and Child Tax Credit are refundable tax credits that require taxpayers show earned income for the year in which they claim the credit. And for both of these credits, earned income means wages, salaries, tips, and other employee compensations. The EITC provides a credit as a percentage of their earnings up to a certain maximum, while the CTC provides a credit up to $2,000 per qualifying child, which is subject to an income phase-out limitation for taxpayers with earned income above $2,500. As I mentioned above, this legislation will allow taxpayers who have lost employment in 2020 or suffered from significant financial difficulties to claim a bigger credit by looking back at 2019 earned income level. And next slide. Last but not least, the CAA provides for a number of qualified disaster relief provisions that are very similar in nature to the Cares Act. Taxpayers who were impacted by certain federally declared disasters may find the following provisions helpful. Usually a 10% early withdrawal penalty applies to a distribution from employer retirement plan to an employee who is under the age of 59 and a half. The CAA provides that the 10% early withdrawal penalty does not apply to any qualified disaster distributions, and such distributions must be made no later than June 25th, 2021. The IRS allows taxpayers to take out a loan from their 401k accounts up to 50% of vested balance up to $50,000. The CAA now expanded this limitation to $100,000 if the loan is made because of a qualified disaster. Any excess amount would be treated as taxable distributions. And taxpayers should also be aware that the CAA does not extend the temporary waiver of required minimum distributions under the Cares Act. Taxpayers who are affected should plan on resuming those distributions for year 2021. And I believe that's all I have for you today. So now I am going to pass it over to Brad to continue. Brad?
Hi, everyone. My name is Brad Shimko, and I am a tax manager at our Beechwood office. And I will be going through some of the key business provisions and extenders of the Consolidated Appropriations Act. Next, please. So first, the Paycheck Protection Program was established under the Cares Act to help certain small businesses impacted by COVID-19 to keep their workers on payroll. And under the Cares Act, it provided that a recipient of this loan may use the proceeds to pay certain payroll costs, employee health care benefits, mortgage interest, rent, utilities, and other interest on existing debt obligations. If the loan proceeds were used to pay these costs, the taxpayer would be eligible to have the loan forgiven. And as well, the PPP loan forgiveness would not create taxable income, and the code generally doesn't allow a taxpayer to deduct expenses that are paid with tax-exempt income. The IRS issued guidance, and Congress sought legislation to make those allowable expenses deductible. So what happened under the CAA was that it provided taxpayers whose PPP loans are forgiven are actually allowed those deductions for otherwise deductible expenses paid with the proceeds of a PPP loan, and the tax basis and other attributes of the borrower's assets will not be reduced as a result of the loan forgiveness. And what that means is not only do you not have to pick up the PPP loan proceeds that were forgiven as taxable income, you also now will be able to take those expenses, and you will also be able to increase your tax basis by the tax-exempt income when the loan is forgiven. Next slide. So next, the Economic Injury Disaster Loan provided economic relief to small businesses and nonprofit organizations that are currently experiencing a temporary loss of revenue. And the CARES Act expanded this and established an emergency grant to allow an applicant to request a $10,000 advance on that loan. And it provided loan repayment assistance for certain recipients of CARES Act loans. Now, what the Consolidated Appropriations Act did was it clarified that the gross income, that gross income does not include forgiveness of those EIDL loans, emergency EIDL grants, and the loan repayment assistance. And just as with the PPP loan proceeds, it clarifies that those deductions are allowed, and if the loan is forgiven, and the proceeds of those loans and tax basis and other attributes will not be reduced as a result of that. Next slide. So next, generally, the Treasury Department required a lender that discharged at least $600 of borrower's indebtedness to file a Form 1099-C, cancellation of debt, and to provide a copy of that payee statement to the borrower. Now, what the Treasury Department did with the Consolidated Appropriations Act was waive those reporting requirements for any amount excluded from income by, certain loan amount forgiveness from the PPP and emergency financial aid grants and other business financial assistance under the Cares Act. So the next thing is farmers' net operating loss changes. And under the Cares Act, it provided that NOLs arising in the tax year beginning after December 31st, 2017 and before January 1st, 2021 could be carried to each of the 5 tax years preceding the tax year of such loss. And what the new provision is that it allows farmers who elected a 2-year NOL carryback prior to the CARES Act to elect to retain that than rather have to claim the 5-year carryback that was provided in the CARES Act. It also allows farmers who previously waived an election to carry back a net operating loss to revoke that waiver as well. So the next thing is depreciation of certain residential rental property over a 30-year period. And under the Tax Cuts and Jobs Act, it allowed real property trade or businesses to elect out of the business interest deduction limitations of Code Section 163J. But however, the electing taxpayer had to treat that property, whether it may be non-residential real property, qualified improvement property, or residential rental property, as subject to the alternative depreciation systems for tax years beginning after December 31st, 2017. And what the alternative depreciation system is it uses a straight line method of depreciation, and also generally increases the number of years over which property is depreciated. So thus it decreases the annual deduction of depreciation. Now, what the Tax Cuts and Jobs Act also did was it changed the ADS recovery period for residential rental property from 40 years to 30 years for property that was placed in service after December 31st, 2017. And what the Consolidated Appropriations Act did was, for tax years beginning after December 31st, 2017, it assigns a 30-year depreciation period to residential rental property, even though it was placed in service before January 1st, 2018. Now, that's if the property is held by an electing real property trade or business and before January 1st, 2018, that it was not subject to the alternative depreciation system. So the next thing I want to discuss is the 50% limit on business meal deductions is suspended for meals that are provided by restaurants in 2021 and 2022. So previously, taxpayers were generally allowed to deduct ordinary and necessary food and beverage costs associated with operating a trade or business, and that included meals consumed by employees on work travel. Now, the deduction would generally be limited to 50%, provided some certain exceptions. What the Consolidated Appropriations Act did was the 50% limit would not apply to expenses for food or beverages provided by a restaurant that are paid or incurred after December 31st, 2020 and before January 1st, 2023. Now, it would also include takeout and delivery meals that were provided by a restaurant. Those would also be fully deductible. Now, we're still waiting. We need additional guidance from the IRS in what constitutes a restaurant for purposes of this. A good example would be, would a catering would a catering business qualify for this? So we're still waiting for additional guidance, and as soon as that comes out, we'll be providing updates. Next. So next, I wanted to go through some of the business tax extenders that came with the Consolidated Appropriations Act. And the first one I wanted to go through is the energy efficient commercial buildings deduction. And that was made permanent. And what that does is it allows taxpayers the opportunity to claim a deduction for energy efficient improvements made to lighting, heating, cooling, ventilation systems, water systems of commercial buildings. Next, the look-through rule for related controlled foreign corporations has been extended through 2025. And then next, the new markets tax credit, which is available to both individual and corporate taxpayers, and it's equal to 39% of the capital invested in a qualified community development entity, a for-profit or not-profit entity that commits to the rules of this program, which in turn must loan or invest substantially all of such capital in a qualified business operating in low-income communities. Under the pre-act law, there was a $5 billion allocation that was made for 2020, but there was no allocation thereafter. The act extends the $5 billion new markets tax credit allocation for each calendar year from 2020 through 2025. So next is the work opportunity tax credit. And this is an elective general business credit that's for employers hiring individuals who are members of one or more of 10 targeted groups. And under the pre-act law, the credit, which is based on qualified first-year wages paid to the hire, it applied to hires before January 1st, 2021. Now, what the act does is it extends the credit through 2025. And it applies to individuals who begin work for the employer after December 31st, 2020. Next, the act also extends empowerment zone tax incentives through December 31st, 2025, and it's for the period for which the designation of an empowerment zone is in effect. And finally, the act also extends the employer credit for paid family and medical leave through 2025, and it employs to wages paid in tax years beginning after December 31st, 2020. Next, I'm going to turn it over to Ed, who's going to discuss the employee retention credit.
Okay, afternoon, everyone. As Brad had said, I'm going to talk about the employee retention credit. And basically what it is a refundable credit for any taxes that employer pays on an employee's wages. So there's a 6.2% withholding that the employer pays on the employee, and they can get a credit against that, and it is refundable, so it's not limited to the tax you paid. The first few slides of my presentation will give you an overview of how the credit was calculated for 2020. And what I'm going to do as I go through each one of those provisions within the 2020 calculation, I'm going to let you know what the change was as a result of the Consolidated Appropriations Act, so you can get an idea of what the difference is between how it was calculated for 2020 and how it's calculated for the first 2 quarters of 2021. So basically, as I had said, this is a refundable credit, and it's equal to 50% of whatever the employee's eligible wages are, and that'll be defined later. The change for 2021, the 50% will go to 70% of the qualified wages. The maximum amount of qualified wages that can be used for any employee for 2020 was $10,000 for every quarter that the employee had wages. So if an employee had $5,000 of wages in Q2 and $10,000 of wages in Q2, they're limited to the 5 for the second quarter and 5 for the third quarter. You can't take the additional 5 because it's limited 10,000 for the whole year for that employee. And the credit, when it was originally came out in the Cares Act, was effective for the period March 12th to 2020, and that was extended as a result of the Consolidated Appropriations Act, until June 30th, 2021. So to put those three pieces all together, the way it would look if you had an individual that had $10,000 of wages in one quarter and $10,000 of wages in another quarter, the maximum credit for 2020 would be $5,000, because you'd be limited to the $10,000 total for the year times the 50%, so you get the $5,000 credit. However, for 2021, the credit would actually be $14,000, because you can take the limit of $10,000 for quarter one, take the other $10,000 in quarter two, and then you'd have $20,000 multiplied by the increased 70%. So it's more of a credit in 2021 than what it was in 2020. And there's probably going to be more people that are going to be looking at this for 2021, because this ties into the payroll protection loans that individuals, companies received last year, with the requirements for being eligible for these loans a little bit different for 2021. More people might be eligible for this employee retention credit. Next. And here's the definition of what an eligible employer is. And there's two prongs to this test. The first prong is, and it's an OR test. So either one of these, if you qualify under either one, you would qualify to take the credit. The first one is that the operations would have had to have been fully or partially suspended as a result of COVID-19 during the year. And then examples of this would be closing of all non-essential businesses, which that happened for part of 2021, where there's an order that impacts the operating hours of the trade or business, or where there's a mandate that requires a workplace closure for cleaning and disinfecting. All those would qualify under these provisions and would enable the employer to apply for the employee retention credit. Next, please. The other provision that can be met to be able to take this credit, and like I said, it's no or. So if you have either one of these situations, you can take the credit, or you can at least qualify to calculate what the credit would be. If there's a 50% decrease in your gross receipts in 2020 for any quarter compared to the same quarter in 2019. So if you have more than a 50% in gross receipts in the first quarter of 2020 compared to what first quarter of 2019 was, then you qualify to take the credit. And then what happens once you qualify in any quarter, you'll automatically qualify for the next quarter if number one, if it's still less than 50%, but it can go all the way up to 80% of the gross receipts of the 2019 quarter, and you still qualify for that quarter till the end of it. So it basically will get, for the most part, anybody that qualifies for one quarter is probably going to qualify for the next quarter, as long as that 80% didn't happen until the beginning. So if it happened in the first month of the next quarter, you get to calculate the credit and you qualify for the credit for that second quarter. It doesn't automatically throw you out of it once you hit that 80%. With the Consolidated Appropriations Act, they increased the 50% to 80%. So basically, you have to be within 80% for the whole time. And then this change is only effective for 2021. So it's just for the first 6 months of 2021. So once you're less than 80% of whatever the gross sheets for the comparing quarter for 2019, then you would meet the requirements. And in this case, you would probably qualify for the first two quarters, because if you meet the first quarter, you're going to meet the second quarter, because as long as you meet that 80% requirement for the first month, you're going to be okay to have the credit for the second quarter as well. Another thing that they did change when you're looking at this for 2021 is you look at the quarters in 2019 to compare to 2021. So you look to see if you have that 80% or a 20% decrease basically is what it ends up being when you compare, let's say, the first quarter of 2021 to the first quarter of 19. One thing that they let you do for 2021 only is to, you could use the fourth quarter of 2020 to compare that quarter to the fourth quarter of 2019. So for example, if you don't qualify taking the first quarter of 2021 and comparing to the first quarter of 2019, you can take the fourth quarter of 2020 and compare that to the fourth quarter of 2019. And then your second quarter would have to be comparing to the second quarter of 2019. And the reason being is if you didn't qualify for the first quarter by using the 2019 first quarter compared to 2021 first quarter, you're not going to be able to look back in that second quarter of 2021 to use the first quarter of 2021 and look at 19 because you already didn't qualify. So it really isn't going to make any difference. At that point, it looks like, and there really isn't any guidance on it, but it looks like probably it's a quarter by quarter election. And most likely for that second quarter of 2021, you're going to be looking at the second quarter of 2019. Also, just wanted to give you an overview of what gross receipts are. Gross receipts are considered total sales, less returns and allowance, and all amounts received for services. Gross receipts also include interest, dividends, rents, royalties, and net gains from the sale of fixed assets. So it's not the gross proceeds when you sell the asset, it's the net gain that you incur, or it could be a loss because it's basically the gross proceeds less the basis in the asset. And other than that, there's not a whole lot of other guidance as far as what receipts are to be used. My guess is that probably any kind of stimulus money that you received, if it's taxable income, you probably are going to have to include it in your gross receipts. So it could affect the calculation, depend upon when you got that money. And I'm assuming there again, there's no guidance on this, that they're referring to whatever your gross receipts are on a taxable basis. There's been questions as far as, if you have different method or whatever for books that you do tax as far as accrual versus cash, what are you supposed to be looking at? My guess is you're going to be looking at whatever your tax basis is. There again, there's no guidance out there yet on this, so we'll wait to see what the IRS comes up with. Next. As I had said before, the maximum amount of qualified wages that you can use for an individual for 2020 is $10,000 throughout the whole year, and then it's $10,000 per quarter for 2021. Qualified wages also include qualified health plan expenses that were paid by the employer to the employee, and that is all those expenses that are applicable to those employees, but they're not included in their W-2. So it's an employee benefit that the employer is paying. Those also are included as part of the qualified wages. Another provision that was in 2020 to prevent people from inflating what the credit would be is that you could not pay an individual more than what they had been paid the preceding 30 days for that same period. And that applied for 2020. For 2021, the Appropriations Act eliminated that provision. So you could do that in 2021, where you could give an individual more than what they had been paid before as a bonus or something like that, and that can be part of the computation and figure out what your credit's going to be. But there again, once they're above the $10,000, it really doesn't matter. If they're above that $10,000 for that quarter, it doesn't matter if you give them another $20,000 in bonus. It won't make any difference. For 2020, the credit was calculated and determined under two scenarios as far as employers were concerned. If you had less than 100 or fewer employees, then you could take the credit regardless of whether people were working or just working reduced hours. If you were over 100 employees for 2020, you could only take the credit if those employees were not working. So that was a big difference in calculating the credit. For 2021, the 100 employees has been increased to 500 employees. And the employees, the calculation and determination of the employees is based upon what's considered a full-time employee. Next slide, please. And the definition under the Cares Act for a full-time employee was any employee who worked an average of 30 hours per week or 130 hours of service for the month. So once that person was in that category, and then what you figure out is what your total full-time employees were, and then divided by the total number of months during the year to come up with what your actual total average full-time employees are. Now, as I had mentioned before, this credit was tied in with the payroll protection plan, and wages used for the payroll protection program loans are not eligible for wages in calculating the employee retention credit. In addition, if you have any other credits that are based upon the wages, those wages cannot be used as well for the employee retention credit. And for an example, if you have work opportunity tax credit, any wages that are used for that can't be used for the employee retention credit. So that's why I say, when I was talking before, I think there's going to be more of an opportunity for employers to be eligible for the employee retention credit because of the changes and the limitations for the availability of the payroll protection program for 2021. Anyone that received a loan in 2020 that was ultimately deemed to be that it should be repaid and it wasn't forgiven, then you can go back and treat those wages that were used for the PPP loan as wages for this employee retention credit. Now, there's still an awful lot of uncertainty out there as far as, the first thing is, okay, 2020, we can go back and we can look and see what our total eligible wages were, which include your health care, and figure out how much we needed for the payroll protection program loans. And if we have excess, then what we can do is treat some of those expenses to be able to get the employee retention credit. And so the thought was initially when this act was first came out, it appeared that you would be able to go back and recoup some of this money through these refundable credits. But there's really no guidance on how you can go back now and retroactively get those refunds, because when you read the act, it appears that that's the case, and that you could just, and they had it a possibility that you could determine what your refundable amount was and include it on your fourth quarter 2020 payroll tax return. But as part of the act, what they did was they separated out payroll in one section, and then a subsection under that, they included the healthcare expenses. And when they're talking about getting a retroactive refund for 2020, they don't mention the section that deals with the wages. They only mention the section that deals with the healthcare expenses. So it doesn't appear that the way that the act was written, that you even have the potential to go back and be able to get a refund on the wages. You can only get it on the healthcare cost. Now, we don't know if that was a drafting error or if that was done on purpose. We just don't know at this point. as part of it, it further says that any loans that are not forgiven, that you could go back and treat those as wages for the employee retention credit. So, and it doesn't, where it talks about the refund, it says basically the healthcare expenses or the wages that were associated with a PPP loan that's not being forgiven. So it almost seems like they're not even giving the option to go back and do the wages. It's either the health care expenses or wages, because it says or in the definition of applicable amount, because it refers to an applicable amount to determine how much of a refund you're going to get. So there's still a lot of question out there as to how that's going to be determined. Do you have the opportunity to go back to 2020 and get the wages that weren't used for the PPP program? I know the AICPA has written a letter to the IRS to get guidance, and I believe they wrote their letter last Friday. So, and I haven't seen anything to this point to see if there's any future guidance on how this is to be determined. I think worst case scenario, I don't see anything that forbids or prevents anybody from filing a 941X, because basically that's where this credit shows up, is on a 941. And I think if you have a period that you qualify, that you both qualify as a business, and you have the eligible employees and you have the wages, I think if you go back and amend your 941, I think you're going to be able to take the credits there. Now, there was a Form 7200 that was out there to get an advance refund of the credit, but I don't think that that's really going to come into play for 2021, because it was basically to get an advance refund based upon 2021, or I'm sorry, 2020. So if you anticipated that you were going to be able to qualify for that during 2020, you could get the money ahead of time and then true it up when you did your 941. But for the most part, I don't think there was a lot of people that were looking at this program because it was not eligible because of the PPP program. And it also was part of the act. And actually, even as far back as the Cares Act, the way this was all set up is that the wages were supposed to be applied towards the employee retention credit first, and that an employer had to make an election to not use them towards this credit, but to use them for the PPP loan. Well, I mean, that's history now. So as far as, employers make an election, I guess the IRS is under the assumption that if you used it for the PPP loans, it's going to be deemed an election to not use these wages for the employee retention credit. So with that, like I said, there's still an awful lot of questions to be answered. I don't think that there's going to be any issues or anything come out that's going to forbid companies to go back and file amended 941s to reflect this credit. So I don't know that there's any urgency, because a lot of people are thinking, oh, we got to get this all taken care of as of February 1st, which is the due date of the fourth quarter 941 for 2020. I don't know that we're going to have the answers by then to know and calculate what your credit is going to be or could have been for 2020 to be able to take it on that return. So I guess we'll just have to wait and stay tuned and see what the IRS comes out with. And like I said before, these are the changes that were made by the Consolidated Appropriations Act. And what I did was try to incorporate that into the way it was for 2020 so that you could see the difference side by side. So you guys can look at this at your leisure if you so wish. And like I said, when we started, that we're running right up to the end of our program, so we weren't going to have the time for Q&A. So that if you have any questions, don't hesitate to send an email. We will respond to all the questions, and it looks like there's a need to provide a more in-depth study of the employee retention credit. So I'm sure we will be doing that sometime in the future, so look for it. And probably what we'll do is wait till there's more guidance from the IRS and then go from there. Thanks for your time. See you later.